Thanks for joining us on Power Lunch. This is Bloomberg Quint and I'm Ira Dugal. Let's get you the headlines. The Indian currency breaches the 69 to $1 mark, trading at its all-time lows. The Indian markets extend losses for the second straight day ahead of the June expiry. The HDFC twins see divergent trends. Suzuki Motors identifies India as its most important global market, says it will increase its products count from 16 to 30. Tata Steel is among the top Nifty gainers today on the back of reports that it managed to bridge the valuation gap in the proposed joint venture with ThyssenKrupp. Our top story today is the Indian currency. Early morning, as the rupee opened for trade, it fell to an all-time low. It was something that was coming, so not entirely a surprise, but let's just run you through what's been happening on the currency. We are trading at about 69 to $1 right now. That takes the year-to-date depreciation to about 8% on the Indian currency. That makes it the worst performing currency, at least in the Asian region. If you look at a longer period of time on the Indian currency, and we've taken data all the way from 2008, so that's a decade, the simple point we want to make here is that India, being a country with an inflation differential with the West, India being a current account deficit country, it is absolutely warranted for the currency to show some amount of depreciation almost on an annual basis. And that's exactly what has happened. If you look at this chart, barring outliers like 2009, 2010, you have seen a steady depreciation in the Indian currency, which is perfectly justified. 2017 was a bit of an outlier when you saw the Indian rupee actually appreciate for the first time in a while. But perhaps that wasn't sustainable, and that message coming through well in 2018 with the rupee already down about 8%. Not to say that the rupee's depreciation is out of line with what's happening across the globe. There's a stronger dollar, there's rising oil prices. All of that has put pressure on emerging market currencies. These are some of the factors well known, but the factors that are playing into the currency. Oil prices being higher is obviously a negative for an oil importer like India. The current account deficit widening, not just because of oil, but also the core balance of exports and imports, ex-oil, ex-gold, is also been worsening. That's a negative for the rupee. The dollar has been strengthening. You adjust to that, obviously. On top of that, you have seen outflows of foreign portfolio investment, 46,000 crore year to date. That's the worst in about a decade based on the data that we compiled here on Bloomberg Quint. That's a negative for the rupee. And trade tensions, while it's tough to quantify those, but certainly an increase in trade tensions should be seen as a negative. What does a weakening currency actually mean? We're not going to get into individual sectors. Some sectors benefit, some sectors lose. Some companies which have external borrowings may take a hit, others may not. But broadly speaking, for existing portfolio investors, obviously it proves to be a negative. That's why sometimes you see a spiraling of a weaker currency into portfolio outflows accelerating. But from an economic competitive point of view, competitiveness point of view, a lot of analysts are now coming to the view that a weaker currency will actually benefit us, help us push up exports perhaps to an extent, and take away the lack of competitiveness which may have built due to a slightly overvalued currency. Those are the factors at play. Let me get a view in as well. Anant Narayan is a money market veteran. He's professor at SP Jain Institute of Management and Research. He's written some prescient pieces on the currency on BloombergQuint.com as well. He's joining us here this afternoon. Anant, thanks for taking the time to speak to us. This was sort of inevitable, right? So I don't want to make a big deal, but I think the writing was on the wall that we would depreciate given everything that's going on overseas and domestically, Anant?
Afternoon, Ira, and always good to be with Bloomberg Quint. Yeah, I guess so. I guess, look, the last few months haven't been great from a macro perspective. Clearly, the rising oil prices, the fact that we also have geopolitical tensions and we don't know what's going to happen to Iran oil and to oil prices in general, the fact that there are trade wars ongoing and India might be impacted, plus the overall sentiment globally obviously impacts us all. To all the points, and I think you've made a fantastic summary of all the things which are besetting the currency markets at the moment. I would just add one more thing. Look, nobody likes a depreciating currency. It makes us all poorer in some sense. And all of us pay more at the petrol pump every time dollar rupee goes up. But the reality is we might not have a choice at this point in time. We have a situation where our basic balance has turned negative. Our current account deficit has been steadily climbing the last couple of years. This year, it might be as high as $70 billion. And our core inflow, which is the foreign direct investments, might be only in the region of $35 billion, which means every month we have a core outflow of about $3 billion. Now, one way we make that up is by borrowing other short-term reversible funds, which is what we did last year and which is why the rupee appreciated. But it's not a very stable balance to borrow fickle money to pay for your oil, your gold, and your smartphones is not a very sustainable balance. So in a sense, a weaker currency might actually help us get the core balance better. It might help us improve our exports. It might help us and the domestic industry reduce imports. And overall balance might be a lot more sustainable. Mind you, it's not just the currency. Obviously, there are lots of issues which beset exports, which beset domestic industry, and capital flows into the country. But alongside that, currency can be a powerful indicator as well.
Anant, you've been in trading rooms when this sort of bouts of depreciation tend to hit the currency. I remember in 2013, everyone was watching the NDF market because that was giving you some sort of negative signals. In the current round, you haven't seen much of a widening of the spread between the spot or the NDF or anything like that. Is that still a relevant indicator? If not, what should we be watching to see whether this depreciation is turning unruly at all? Because so far it seems fairly moderate.
Well, yes, the NDF market remains extremely relevant. And the way in which we measure the pressure from NDF markets is the difference in the 1 month points in NDF markets and onshore. So the 1 month points has been ranging between 25% and 35% when I last checked. I think it's on the higher side today, but it's been within that particular range. At the moment, it's trading higher than onshore points, which indicates that there is more buying offshore than onshore. Having said that, it's not as if there is a drove of outflows happening. You are right, in a sense, this has been orderly. But every time dollar rupee hits a new low, the negative headlines are kind of unavoidable, and we will see a bit of that. In many ways, this is just a correction of the fact that rupee has been overvalued for a while. And as I said, the basic balance has gone awry. Even today, after all this move, and as you said, 8% depreciation in the rupee this year, our RER would still indicate what? 14% or 13.5%, 14% of overvaluation of the rupee. So it's a correction in many ways. And I think there's no need to panic. The RBI has plenty of reserves to quell any short-term issues. Of course, things can always spiral and become worse. And there are people who might be waiting to buy dollars, including FPI in debt, including NRE depositors, including importers who haven't covered so far. But we're still far away from any kind of panic of the kind of 2013 or anything. So, no reasons for those kind of comparisons as yet.
Anand, on the point of the rear, yeah, it's about 114 or so on the index last count. In the past, we've generally tended to maintain or be comfortable with an index close to 108, 110, right? Should one go by that to say, how much further the rupee can weaken given the current scenario? I know you're not in the business of forecasting anymore, but just broadly.
No, look, it's a very pertinent point. In the past, and particularly in the first decade of this millennium, I think the RBI used to watch the RER a lot more closely. And we haven't seen too many times when rupee has been overvalued by more than 12, 13% on a sustained basis. Earlier this year, if you remember, Ira, we saw the overvaluation go as much as 21%. I think in January it was RER was 121. I must add a few caveats. The RER is not a perfect measure. It takes an artificial base year, and you can always argue why take that year, why not some other year. And the second thing it doesn't adjust for is for productivity differentials. And typically, India, you can argue, productivity is growing faster than other countries. Having said that, I do think RER of 120% was extremely high. And that played a part in the earlier point I made about our basic flow going negative. I think one of the reasons why exports disappointed last year and imports actually grew quite rapidly, not just in oil, but also in gold, also in smartphones, also in non-oil, non-gold, was because of this currency issue. It's not shown by research, but I do think there is a strong connectivity there, which is why some amount of correction of the RER is actually desirable. In fact, I would argue that we should not look at artificial milestones like 70 or 71. Even if a dollar rupee goes to 70 and RER is still at about 110, I think it's absolutely fine and gives domestic industry a better chance to balance matters out. Will it go there? I don't know. I think in a politically charged atmosphere where it's an election year, headlines of 70 might not be palatable, and therefore the RBI might flex its considerable reserves and hold the rupee, which is, to me, a bit sad. I think a bit of more competitiveness on the rupee is not a bad thing.
Last question, the last piece you wrote on Bloomberg Quint, you said faith and prayer are our core strengths, but do not make them a cornerstone of economic strategy. I thought that was a great line. Apart from that, should the RBI start looking at, or at least keeping at the back of its mind measures it may need to take should this actually become, a little bit unruly? People are already talking about NRI bonds, etc. Are you at all in favor of that?
Okay, so look, while we talked about the rupee currently, I think what's important from this entire episode is that there are some core vulnerabilities that we have to address. Chances are that we'll get by through whatever mini crisis or actual crisis is thrust upon us. We've always come out of crisis. But, that should not take away the fact that we've allowed some core vulnerabilities to build. First is our exports are floundering, and something has to happen there. I think it's about infrastructure, it's about the issues, the short-term issues of GST and demonetization, maybe an overvalued rupee. Whatever is it that's besetting exports, I think has to be addressed on a urgent basis. On imports, likewise, it's not just smartphones. Even the plastic broomstick you buy in Big Bazaar is made in China. I think there is a lot of stuff that we can do for domestic industry again for it to become a lot more competitive. And those core issues need to be addressed. Likewise, one issue that I thought we went through the last year is because of our intervention in monetary policy, we saw a lot of hot money accumulate the last year, which actually pushed rupee stronger despite the adverse core deficit which was building up. And I think that's a problem. You cannot have so much of hot money coming in to fund your oil and your current account deficit. And that again requires a review of our overall monetary policy and intervention policy framework. So all these things, and lastly, there's always the elephant in the room of the financial stability and the structure of banking in the country. It does impact the external sector as well, especially for a country that's looking to raise capital from overseas. We have to strengthen our banks, and there are lots of things we should be doing on that front. So while we address the immediate issues using RBI's reserves, using whatever policy measures are required, I think it's important we don't let this crisis go waste, and we address the core issues in exports, imports, capital flows, and our banking system. Lastly, look, all these special measures of FCNRB deposits or the 300 basis points rate hike that we saw in 2013, those are all knee-jerk reactions. These are homegrown remedies. There's imperfect science behind it. They've worked in the past, but that doesn't mean that it's cheap. In fact, it comes with a lot of hidden costs. We're nowhere there as yet. RBI still has plenty of reserves. If we do get to the stage where things get worse from here globally and there are other triggers, obviously we'll have to mull some other kind of special schemes. But I do hope that there's a thought which goes behind which scheme we actually choose. The ones you mentioned actually are pretty expensive when you get into the actual nitty-gritty.
All right, Anand, leaving it there for now. Thanks so much for joining us for a quick conversation there on the currency, the macros behind it actually, more than just the levels. Let's get another view. Let's get a view in from Moody's. They put out a note today, in fact, saying that India is one of the least vulnerable countries. Joining us on the phone line is Christian de Guzman, Vice President at the Sovereign Risk Group at Moody's. Christian, thanks so much for taking our call. Apologies to keep you waiting. Your note says that India is actually in this time in the club of the least vulnerable rather than the most vulnerable. Should this currency pressure persist?
Yes, that's right. I think it's important to note that our sovereign ratings, which we are commenting on, really have to do with the government repaying its debt. So I think what we're trying to say here is that the currency depreciation in the current context is really not much of a factor when we look at the government's ability to pay back its debt. It is indeed, amongst emerging markets, probably one of the most dependent on domestic local currency sources of financing. And so the converse of that really is that the government, at least, and we're not saying the economy at the whole, but the government at least is less dependent or less vulnerable to these currency swings.
Christian, just to understand this, when you look at the external indicators, so if you're looking at reserve cover, etc., are you measuring it mostly on imports? Are you looking at it as a percentage of short-term debt? Are you also adding NRI deposits into it to judge, the external vulnerability at your end?
Sure. Okay. There's two things that I think that we're talking about. I guess what I was mentioning just now was the proportion of the government's debt that's denominated in currencies other than rupee. And then, of course, there's another aspect of external stability, which is reserve coverage. And here we are looking at what we call the external vulnerability indicator. So we're not like the IMF. We're not looking at months of imports. We are a debt rating agency where we're concerned about the government's ability to pay back its debt. So we're looking at the amount of short-term debt NRI deposits, because we're looking at non-resident deposits, as well as any long-term debt that's coming due over the next year, and take that sum as a proportion of foreign currency reserves, which we think still is quite ample in the case of India.
All right, Christian, a broader view, when you look across Asia, which are the economies which are, most vulnerable or least vulnerable, or are the more vulnerable economies actually this time around outside of Asia? Argentina, Turkey have been mentioned in your note.
Yes, indeed. Well, in the case of Asia Pacific, I mean, there are a couple of names that still stand out in terms of this vulnerability to a stronger U.S. dollar and the sort of associated capital flows. At the very top, we do worry about Mongolia, which is rated well below that of India. Elsewhere in the region, we're looking at Sri Lanka and the Maldives. So these are sort of the top three that we're looking at in the region. But there continues to be, some pressure points outside of the region that are much more prominent. We're looking at places like Turkey, Zambia, Ghana, Argentina. Of course, Turkey and Argentina garnered the most interest because they do have a lot of tradable debt.
All right, Christian, thanks so much for that quick view. That's the Moody's view on sovereign. There is, of course, the impact of the weaker currency on individual industries, on individual companies based on external debt that they may have. But that's at a country level. And at a country level, because India has very little external debt, dollar-denominated debt, these bouts tend to be slightly less impactful on the sovereign rating. But one of the things that we mentioned in terms of the currency and the pressure that's been building up on it is the fact that you have seen foreign portfolio flows actually turn into outflows. So you've done 46,000 crore or so in outflows, both on debt and on equity. That is apparently the highest that you've seen in about a decade or so. Jayesh is standing with us to give us a sense of what the numbers on portfolio flows and ETF flows have looked like. Jayesh.
So, Ida, clearly it's been a bad start to the year. If you have a look at the equity and the debt numbers in terms of the foreign investments, what you have in 2018 so far is for the equity portfolio, they have sold about nearly 6,000 crores, and for the debt portfolio as well, 41,000 crores or thereabouts that they have sold. Now, look at the trend for the last 10 years, not a single instance where you have seen a negative number for equity. So, this is something that is, worth mentioning as well. And if you look at the debt number as well, 41,000 crores of outflow this year. In 2016, we had a substantially smaller number. So did in 2013 and 2009 as well, where the number was not so significant, but still outflow number for that. Now, how does this the total stack up? If you have a look at this, 47,000 crores or thereabouts the total outflow, and not once in the last 10 years have we seen an outflow during the first half of the year, which is Jan to June 2018. We have seen 47,000 crores go out of India as well. Now, a good benchmark to see where the ETF flows are actually, and compare India to the other emerging peers. You can see that India is at the bottom of the list, about $1 billion of outflow from the ETF market. Where has all this money gone to? So you have a look at China, about 20 billion invested in China, followed by Mexico and Brazil as well, sitting with $1 billion plus inflow in the ETF market. Now, how does the India ETF market look like? If we can have a look at that, it will show you that what are the total assets and what flows we have seen in each of those assets. So the equity portfolio comprises of about 24,000 million USD assets that we have, and $1 billion has gone out from there. Commodity is worth mentioning because gold is the only underlying that the Indian ETFs track. So we have about 888 million in the US in the gold assets, which has seen an outflow of just about 15 million. Fixed income and specialty ETFs are the other ones, 327 and just $1.67 million, and not much in terms of the inflow outflow for the entire fixed income petrochem and specialty space. But overall, bad start, in fact, the worst start in about 10 years for the entire FPI.
All right, thanks so much for putting that data in perspective. Let's move on. A delay in Fortis Healthcare's results means a delay in the bidding process as well. In a conference call held with analysts last evening, the management promised that the audited results will be released soon. The bidding process will be conducted only after that. Darshan Mehta joins us with the key takeaways from that con call. Darshan.
Okay, so basically soon by soon, they didn't give any timeline. They said that will come out, but it will be in the next few weeks. So what had happened was because of the delay in results, the management said that the bidding process, which was supposed to conclude today, the deadline has been extended. They are saying that after the audited numbers will come out, then only will the bidding start now. Now, they have said that it will not be a few weeks, but within that, so over the next 2-3 weeks, we can expect some bit of clarity coming in from Fortis. The second part of this was in terms of brand. The entire Fortis and SRL brands are currently owned by the Singh brothers. Fortis and SRL are brand cost almost 3 crores a year that are paid in license fee, and it's a 9-year agreement, and currently they are in year number 3. The management said they will do all to ensure that there's no issue as far as brands are concerned, and they will protect it. Thirdly, they spoke about what Malvinder Singh was. They annulled the appointment of Malvinder Singh. He was named the lead strategic initiatives in September 2006 and paid a hefty compensation. They're saying they will recover payments made to Malvinder in that role or recover any company assets in his position. And finally, a few notes in terms of RHT. Firstly, in terms of the intercorporate deposit, they're saying they'll be more aggressive in recovering the improper loans. And on RHT, they say they have till the end of the year to close the entire deal.
All right, thanks so much for that, Darshan. Maruti Suzuki sells more cars in India than all other automakers combined, and that's prompted Suzuki to reiterate its focus on India. The Japanese auto giant, which held its AGM in Japan today, says it plans to take its total number of offerings in the Indian market up from 16 to about 30 over the next few years. Yatin Mota is taking us through the details. Yatin.
Well, if you look at Suzuki, they had an AGM in Japan, and they reiterated the growth that they look at on a global perspective. Of course, India remains a very big market for them, and Maruti Suzuki will play an important role, is what the management reiterated. Of course, in order to meet their 5 million car sales in India via Maruti Suzuki, they need to ramp up their distribution network, and they need to ramp up their total offerings that they have in terms of the car models. And probably for that reason, Suzuki informed its shareholders that they are looking at a total model count of 30 from the current 16 by 2030. And not only that, they are looking at a large dealership network of over 10,000 across the country in order to support that 5 million car sale figure by 2030. And they also believe that in order to sustain a 50% market share or 50% plus kind of a market share, they also need to be present aggressively in connected cars, which they probably will launch a product by March 2019, and also electric vehicle segment, wherein they believe that the offering that they would have probably will also help them maintain a 50% market share even in that electric vehicle segment. So on an overall basis, if you look at Suzuki's commentary, they are looking at a 5 million car sales for Maruti Suzuki. That will be a 10% CAGR till 2030. And in order to augment that 2030 target, which is 2030 target, they will be looking at, revamping the entire dealership network and also the kind of offerings that they have in terms of product, which is basically almost one new product every year to reach that 30 product mark by 2030.
Yatin, thanks so much for that. Mention of Indian Bank. The bank has informed stock exchanges that it will not be paying out a proposed 6 rupees per share dividend. What appears to have happened is that the bank had decided to declare the dividend after spreading provisions for mark-to-market losses on its bond portfolio and also gratuity payments. However, the RBI has communicated to the bank that the dividend can only be declared after the full mark-to-market hit has been accounted for and taken. Shares of Indian Bank are trading lower following that announcement, a cut of about 1.5% after that came through on the exchanges. Let's take a quick break here. On the other side, we'll talk about crude oil prices, a key issue in the currency as well, but what's happening in the crude markets, that coming up on the other side of the break.
Sir, please believe me, I am in this business for the last 12 years. Okay, I'll wait for your call. Thank you so much.
They still don't know you after all these years?
क्या करें? पहचान ही नहीं है.
Simple solution hai. List on the stock exchange. With listing comes recognition. Investors get interested in you. And funding happens.
Come on, yaar. I'm not big enough to list. Chal, let's leave.
Arey, there's a stock exchange exclusively for your kind of company. NSE Merge. It's the right platform for your business.
Really?
Yeah,
My kind of company?
exactly. Get listed, get recognized. अरे भाई हीरे की असली परख जौहरी को ही तो होती है. चल.
NSE Merge, साथ हमारा, सफलता आपकी. The SME Growth platform from India's largest stock exchange.
The promise of GST was a bold one. Has it delivered? Join BQ as we take a deep dive into the year gone by, from our vantage point to yours. Watch the fine print GST special all week only on Bloomberg Quint.
Welcome back. You're watching Power Lunch. Let's take a look at the headlines. Indian markets extend losses for a second straight day ahead of expiry. The HDFC twins see divergent trends. The rupee breaches the 69 to the dollar mark in morning trade, trading at record lows. Crude prices are trading at the highest level since November of 2014 after US inventories fall to a 16-month low. All right, let's check in on the equity markets right now. Agam is joining us with the details of how markets are trading. Agam.
Well, more weakness coming in for our markets. In fact, the indices are trading near days lows when it comes to the Nifty as well as the Sensex. The Nifty is looking at a cut of as much as 0.5%. Sensex decline is not as bad, but the Nifty Bank again down by as much as 0.2%. Among other pockets, when it comes to the broader market indices, clearly the mid cap and the small cap indices are both underperforming, and we've seen about a 1% decline in both these indices coming through. And well, a few sectors that stand out in trade, of course, is metals, lightly led by just a handful of stocks out there when it comes to the metal index. So metal index is up and about as much as 1%. But other than this particular sectoral index, all other sectoral indices are trading in the red right now, with the most weakness coming through in the realty sector. Again, in terms of stocks, when it comes to the big movers and shakers, we have Tata Steel and M&M, which are advancing in trade, and Infosys holding on largely on the back of the strengthening dollar against the rupee. And on the other hand, we have Tech Mahindra, which is down by as much as nearly 5% right now. Titan, Gale and Grasim, among others, which are looking at some amount of profit taking. On the whole, the market breadth continues to be on the side of declines, and that will remain a matter of concern over the next few sessions. Finally, as far as the technical analysts are concerned, they regard that as 10,650 to be a crucial level, and should we close below that mark, we could expect a little more weakness over the next few sessions, Ira.
All right, Agam, thanks so much. That's the equity market check. Switching focus to commodity markets, crude prices are trading at the highest level since November of 2014 after U.S. inventories fell to a 16-month low. It could rise further if supplies from Iran go out of the market, says Amrita Sen, chief oil analyst at Energy Aspects. Speaking to Bloomberg News, Sen says that crude prices could go as high as $90 per barrel by the end of the year. Listen in.
Be a lot of upward pressure on oil. I mean, look, right now there's a little bit of prompt overhang still in the Atlantic basin, which we are clearing off because we had really high U.S. exports in the past. But once that clears up, I mean, you are looking at substantial upward pressure. I mean, there's no reason why we couldn't trade into the 90s, even probably higher by year end, given the volume of oil that we're talking about that could be lost.
Amrita, let me bring you over to my chart, which is basically looking at Saudi Arabia planning to pump a record amount of crude in July. How concerned is the market right now that if the Saudis do increase production, there just won't be enough spare capacity?
That's it. That's part of the problem. Well, you know, the other issue with what happened yesterday is that Saudi Arabia were putting out different numbers every hour almost, right? It was 10.6 at some point, became 10.8, became 11. I think the market really thinks it's panicking. And like you said, I think firstly, even if we assume that Iranian exports are not going to go to zero, we don't think it's going to go to zero. We think it should be about 1 million barrels per day. That's still a drop of about 1.5 to 1.6 million barrels per day from May levels. Saudi Arabia can only increase by about 1 sustainably. Of course, it can do more over time. It basically leaves us with no spare capacity at a time when Iran isn't the only issue. Venezuelan production's falling, Angola, Libya, Nigeria. There are lots and lots of issues everywhere in the world. What more can Saudis do?
All right, let's bring the conversation back home. The Modi government plans to spend more money on supporting small exporters. Yesterday, the cabinet approved a capital infusion of about 2,000 crore into the Export Credit Guarantee Corporation. This would happen over a period of 2 to 3 years. The investment will help enhance insurance coverage for small, micro and medium enterprises in the export business. Let's get a sense of what this means for the export community. Mr. A. Saktivel, Regional Chairman at FIO, that's the Federation of Indian Export Organizations, joins us on the phone line. Good afternoon, Mr. Saktivel. Thanks for taking our call. Can you explain to us how significant this is and why this is being done at this particular time, the increase of the capital base of this guarantee corporation?
See, actually, this will help the MSME exporters because when we want to go for a new market, and especially this African and South American countries, we don't get proper LCs. So we have to do the DADP basis. That time we definitely need the CCGC help. So it will help us, the small exporters, to expand the market, and also it will give a safeguard to the small exporters. The risk what they're taking will be safeguarded.
Sir, is there a reason why this is happening right now? I'm just wondering whether, sort of more exporters are tapping into this guarantee corporation, which means that their capital base has to be increased?
Not the cheap. It's a continuous help to the MSME exporters. Now, the government thought that the traditional market is now we have saturated to some extent. So we have to go for a new market. The new market, when especially for MSME exporters goes, they need a kind of a guarding effect. So the ECGC gives the guarding effect to the MSME exporters.
Okay. Mr. Saktivel, since we have you on the phone line, let me just ask you, what things are looking like on the export front. I think last time we had chatted, there was, concern about the disruptions that have been created by GST, etc. Are things looking a little bit better? Have some of those wrinkles smoothened out?
Yeah, see, now looking better, but see what happens, especially garment export, now the yarn price is going up, now the dyeing cost is increased. Now, these are little affecting us more now, but the government is seriously thinking of giving is the embedded taxes refund. Once that is done, then our position will be comfortable.
All right, Mr. Saktivel, thanks so much for that quick call. That Guarantee Corporation and the capital increase likely to help MSME exporters. That's the view coming in from FIO. Let's move on to global news. Disney has come one step closer to purchasing a big chunk of 21st Century Fox. The U.S. Justice Department announced yesterday that it has approved the $71.3 billion deal. What does this mean for the company? Bloomberg's Christine Harvey reports.
Disney yesterday secured the approval from the DOJ after agreeing to sell off Fox's regional sports businesses. And now the Wall Street expectation out there is that we will see Comcast come out with a counter bid. Remember, Disney's latest share is latest offer is for $38 a share. A person familiar says that Comcast is now currently mulling its options, and it's actually considering teaming up with private equity investors to go after Fox assets. It does have a little bit more time here now. I mean, Fox has canceled a shareholder meeting that was planned for July 10th in which it was going to vote on the Disney proposal. So we'll have to wait and see what Comcast comes out with here. Remember, Disney and Comcast are both in the game for Fox because they're trying to boost content, really expand their footprint overseas, and take on challengers like Netflix.
All right, from the family that owns the Mars Bar brand to a famous Belgian beer making dynasty, the world's 25th richest family in control. Let's listen to which are the families who have the most wealth.
The scale of the wealth. This is $1.1 trillion controlled by just 25 families. Plenty of those names are very recognizable, the Waltons, the Hearst family, and then over in Asia you have the Lees of Samsung. So you've got just the sheer scale and like mind-boggling size of these fortunes. And then at the same time just how diverse these fortunes are. So we're not looking at first-generation fortunes like that of Jeff Bezos or Mark Zuckerberg. These are sort of multi-generational. So there's much less of a technology-heavy influence. Instead you're getting fortunes from luxury. You've got the owners of Chanel in there, and also even aviation and data centers.
That's a wrap on this edition of Power Lunch. Thank you for watching. Countdown will be up next.